Hello and welcome back to AIBC Summit YouTube channel. 2021 has been the year of plenty of crypto and blockchain buzzwords, and DeFi has been no different. So for a lot of people that have been watching this space and avidly looking to get involved or just understand a little bit more, I'm joined now by Joshua Bate from Harvest Finance, who's going to give us a process of DeFi protocols and also how they can work for you, whether you're a larger investor or whether you're someone that's just looking to get involved this year. So Joshua, great to have you join us on the line today. How are you?
I'm good, thank you. Thanks for having me, Jessica.
Very welcome. And it was really interesting to have a little bit of a look into Harvest as well, because DeFi is something that has only come on my radar really last year. And since then, it's been a surge where people can't really avoid the sheer magnitude of the industry as a whole now. And for a lot of people that are looking to learn a little bit more, there's probably some questions that they are still looking to get answered. And I think one of the words or terminology that we do see a lot is yield farming, and potentially what it is and how it can work for you as the user. Are you able to give us a little bit more detail?
Yeah, sure. So yield farming is essentially where you take your capital, you leverage it, and you gain a return. Much like when you deposit your money into a bank, you gain, currently 0.5% APY, maybe. It's the same process, but just on the blockchain and magnified at a much more lucrative scale, right? So for example, I have 1,000 Ethereum, I can deposit it somewhere and I can earn a percentage APY on this Ethereum. Currently in the DeFi universe, there's APYs north of 100% on the dollar. USDC, you can get 100% APY around the place on the dollar, which is unheard of. So there's a couple different methods of yield farming. The most popular one is just leveraging or collateralizing your assets. You have your assets, you deposit them somewhere, and the protocol you deposit them in then utilizes and provides you with an APY. Another very popular one is liquidity mining. So Compound is a good example of liquidity mining. They were one of the first to do it, and they basically offered people who would provide liquidity for the comp token an APY reward for doing so. Normally, when you provide liquidity, you gain a small kind of liquidity fee. On Uniswap, it's currently 0.03% of all trades. But Comp was offering north of 100% APY for liquidity providers in the value of their native token. So basically what DeFi has done, or yield farming in particular, as it has allowed people who have usually only gained kind of yield on their assets from speculative trading. For example, Bitcoin goes up, you make money. What has happened is you can hold these tokens and set them to work somewhere and gain yield on them based on just holding the tokens and their intrinsic value.
And it's almost this new element of making your own crypto or your own tokens really work for you while you're not trading actively. So there's definitely appeal there, and I can understand why people are looking more into it. But if you could just help us explain just on a really basic level, because I think, as you mentioned there, low interest rates when it comes to fiat and actual physical banks that we're seeing, where this money, where this really high APY when it comes to token return, where it actually comes from and the process that incurs this way?
So it does depend on the protocol. And this is actually a question that a lot of people ask. And when the answer isn't so clear, and also the answer often involves a secondary token, right? So if a secondary token exists in which you get the APY, this token only has value if someone else thinks it has value. So someone says, where do you get that APY from? We say, well, you get given, token B. Token B, you get given 800% APY in the value of token B. And they say, well, what if token B goes to the floor? And you say, well, fair enough. Then you don't get 100% APY. But also the thing is that currently DeFi is very experimental, right? And the majority of the yield you get isn't actually in USD or USDC. The majority of the yield you get is in a secondary token. Okay. Again, it depends on where you go. For example, currently Curve is one of the most popular DeFi yield farming protocols, right? This is essentially liquidity provision. You provide liquidity of stable coins, USDC, USDT, etc., and they boost the fees you get and aggregate it, and you get given the fees for the trades. So you make a trade, you must commit a certain percentage to a fee, and you get given that money for facilitating the trade. sorry, I'm trying to think how to describe DeFi in a very simple way. It's actually not so simple. I mean, comp is another one. Comp is simple. Okay. So comp, you deposit your Ethereum and people want to borrow Ethereum. So they pay a borrowing fee. The borrowing fee goes to the person who deposits his Ethereum for lending. That's a really simple one. AAVE is a similar. So you have a lot of assets that aren't doing anything. You give them to Compound, they lend them to other users who pay a fee to borrow, and you gain a percentage of that fee. So that's an easy way to set your assets to work for you.
Awesome. And it all sounds really positive when we talk about this, but obviously there is an element where trust really comes into this, and it actually plays a crucial role for people that are kind of lending out when it comes to any projects or protocols being kind of exploited in any way, and any loss of tokens or fear of that. How does Harvest really come to compromise with this and just make sure that for users, their assets are secure when they are going through this yield farming process?
So the number one thing that investors look out for is an audit. Okay, there's a couple reputable audit companies, Certic, PeckShield, a few others, Consensus. These are companies who their profession is to look at code and find vulnerabilities whereby someone can steal funds. Audits are completed in order to prevent hackers from gaining an advantage. But as is common in the world, those who want to commit, the crime, the hackers, for example, are often the smartest people. They look for exposures that the auditors don't know exist yet. Okay, so for example, flash loan attacks. It's interesting to look into. Flash loan attacks was something that no one really had on their radar in terms of auditors, in terms of projects. And then within about 1 month, 3 or 4 huge flash loan attacks occurred across multiple protocols and stole hundreds of millions of dollars in assets. So gaining security is only really as possible as the precedent, right? You know what to look for in order to protect from it, so you put that into your code to protect from it. However, when the new attack vector comes, someone has to get stung by it in order to, know how to defend it. It's very difficult to do preventative defenses to all attacks.
Yeah, absolutely. And it's kind of where the call it white hat hackers come into play there to really help cooperate with that, because security is such a huge element. And just quickly, because I think we're going to go into talking about Harvest now in a second, and some of the work that you guys are doing as well. But we saw a huge surge last year. If we look at a 12-month process of the DeFi industry growing to the sheer volume it is now. So Joshua, just quickly before we go into Harvest, do you think that we're going to see the same amount of growth this year around? Is it an industry that still has this room for potential, or is it something where we've kind of seen a leveling out of appeal?
So I think that we're still going to see almost the same, probably more growth. I do think the growth will be more in terms of market cap and in terms of kind of security and in terms of more applicable innovation. However, over the last year, APYs have been ridiculous. Some people are depositing and earning 200, 300, thousands of percent. I don't think we're going to see that ever again, really. I think that was something that the lucky few gained incredible advantage from, but I don't think we're going to see APYs like that. The hype may die because people are only gaining 30% on the dollar, but I do think as institutions can see the value in that, that's where the popularity will come from. It will come from people with larger amounts of money being able to invest. Whereas before it was more, well, I have $1,000 and I can turn it into $10,000 in a month just by putting it in this protocol. I don't think we're going to have that kind of hype again.
And I have to agree with you there that I think there was a huge hype, and for a lot of people that did manage to jump aboard that lucky train, they would have kind of profited greatly, but I think DeFi has such a huge appeal that if it manages to speak to the 99% of people that are looking to kind of earn some interest and get their money to work for them, then the profitable return there is huge, and the amount of people that it can reach. It's just whether we can breach out of this cryptocurrency community and into the wider audience. So now finally I would love to ask you about Harvest and some of the work that you guys are doing, and just overall just what the service provides and how users can get some more information on the services you offer?
Sure. So Harvest Finance is a DeFi yield aggregator. So it takes all of the opportunities, some of which I just mentioned, Comp, AAVE, Curve, plus many others, and it aggregates them into a single platform. So during DeFi summer last year, people would spend, most day, hours and hours each day finding the best yields and then depositing their funds and gaining money through that. It takes many, many hours to find yields that you can trust, because of the auditing issue, to find the new ones before the APYs fall too low. And for many people, that was a full-time job, right? So Harvest has just basically taken that intense job and made it very, very simple for users. You go to the website, harvest.finance, and you deposit your funds, and Harvest code does all of the work for you. It takes your funds, it deposits it into the protocol and gives you the yield. Another thing it does that's really important is it's auto compounds. So that's kind of like the secret in DeFi, is to make the most money is you have to compound your gains. If after a week you're gaining, certain percent, you take them all out and then you reinvest the entire amount. That's how to really, really, make a lot more money. Harvest does that automatically. The code automatically every day compounds your own yields, so you don't have to. And right now, the Ethereum blockchain is pushing out fees of, $150 for a single transaction, which eats into your profit margins. So you don't have to do that. And let me just check. I think Harvest has saved $28 million in gas fees since it began. And, $28 million just in fees. It's crazy. So the point in Harvest is it makes the very difficult and kind of opaque nature of DeFi much more simple, much more transparent, and much more accessible for basically everyone.
Fantastic. Well, best of luck with things going forward. We're really excited to see how Harvest pans out for the rest of 2021. And thank you so much for joining me on the line today. It's certainly a really exciting time for people that are involved in this sector of the cryptocurrency space. So thank you so much for sharing some of your insights.
Thank you, Jessica. Thank you for having me.
You're very welcome. Well, that's all from myself and Joshua, but we'd love to hear how you found this interview. Are you involved in the sector already, or are you looking to dip your toes in? Let me know in the comments below. You've been watching AIBC Summit YouTube channel, and subscribe for any more content like this.